Joining me now, the analyst behind these calls, Jason Helfstein is Managing Director of Internet Equity Research at Oppenheimer, and Alan Gould is a Managing Director at Loop. I appreciate you guys both joining us to talk this through because you did similar things, but with different outcomes. Jason, I'll start with you. You're not worried that the shares are overvalued here?
Well, first, just on headline estimates right now, it's basically trading pretty similar to Amazon on an earnings basis. So you can say there are other companies in the market trading in a similar level. But really, the reason for our enthusiasm is threefold. Number one, the street has not factored in what live events will do to estimates. So we already have $2.5 billion of ad revenue from the ad tier in 2026, but we think that there's potentially another $2 billion that can come from doing live events, as we learned that they could do with the Tyson-Paul fight. So we have that. And then in addition, they beat operating margins by 400 basis points this year. That's probably where it'll work out. And we only have 1 point of leverage over the next few years. So you could actually argue, unless there's a structural change in the entertainment industry, Netflix is probably going to continue to beat street estimates for the foreseeable future.
Real quickly, Jason, what are its plans with live events? Something I wasn't as familiar with.
We don't know. All we learned is that they probably had somewhere between 2 and 3 or 3 and 4 times the number of people, tune into this boxing match or boxing night. And ultimately, they've proven they can do something that they probably wasn't sure that they could do. And so we'll learn, but this is definitely something that they can unlock going forward.
All right, Alan. So you also raised your price target considerably, but with a cautious view on the shares because you think they're potentially overvalued. So just talk us through that, especially in light of what Jason just said.
Yeah, hi, Kelly. I think they're fully valued in here. We followed Netflix for years. It has its ups, it has its downs. It's kind of hard to predict when you might have some sub-miss or going forward slight revenue miss. It doesn't take much when you're trading at 9.5 times revenue, trading at 40 times earnings. We are back to what has been pretty much a historic high multiple, 9.5 times revenue. I have built into our model, 13% compounded revenue growth going forward from now till the end of the decade. Advertising seems like it's starting to actually gain some momentum in here. And I have margins going from 27 to mid-30s. Now, last year, operating margins went up by 600 basis points. It's one of their largest jumps in operating margin they've had. That is why the company has given a fairly conservative, I would say, operating margin guidance this year of only up 100 basis points. They say they strive for accuracy, not conservatism. But, the company really looks at long term. Their goal is to build, they look at a $600 billion TAM, and they're looking to build it. They're not looking to build it quickly. So I think if the revenue comes in stronger, they spend more on content. Content spends $17 billion this year. I think it'll be $28 billion by the end of the decade with sports. But I think there's going to be more of a moderate growth rate in earnings.
I take your point that it's at the high side of where it usually trades. But what about Jason's argument that it deserves that because it's in such prime position, such pole position? What events next is it related to Disney or any of the other players that could make you think, well, that all of a sudden maybe competition comes back to the fore in a way we can't anticipate or something like that, Alan?
Well, let's keep in mind that the number one player in terms of streaming engagement is really YouTube. It's all ad-driven, not subscription-driven. And let's not rule out Amazon in there. I don't cover Amazon, sounds like Jason does, but, Thursday Night Football is doing pretty well from them, and they seem to have almost an indefinite amount of spending if they want to, and Apple. In terms of the traditional companies where I am more familiar, Disney has actually finally turned profitable. The 4 traditional major studios are still losing almost $1 billion in streaming, while Netflix is earning $11 billion. But next year, the 4 streamers will probably start making money. There will inevitably be consolidation that probably benefits Netflix, but it probably makes for a more viable competitor. So longer term down the road, we see Netflix, Amazon, Disney, and some combination of Peacock, Paramount Plus, and Max, probably driven by Peacock because they've got Comcast as the strongest balance sheet, your parent company, to try and put it all together.